So you're moving to the UK. Well, welcome to good old Blighty. There is someone else that's going to want to say hello. That's right, the tax man. So this video is going to help you to understand what taxes you might be falling into, their pitfall, and how you can avoid it. So let's check out all of the details. Okay, so we have to look at the UK domicile and residence. Now, I'm going to forgive you if you have not heard of domicile. I'm not going to test you on what that means. I'm going to explain that to you a little later on. What we do need to think about is when our tax year starts. And let me be clear about this. The residency test of how many days you're in the UK starts from the 6th of April to the 5th of April. Okay, so it's a fiscal year you need to think about when it comes to residency and planning your trip to stay in the UK. And I'm going to give you an example of for an American that's looking to move to the UK. And you have to time it beautifully to avoid all these nasty taxes that you can have. Let's imagine an American. I wonder what kind of firm can help Americans save tax, or British people moving to America save tax. Oh, that's right. It's Purser Tax. That's right. So Purser Tax is a company that will help you save tax. And when you go on their website, you might see this face. Okay, that is me. All right. Okay. So we can get past all of that. Now, when it comes to the US tax system, it has the same issue in regards to residency. And typically 183 days seems to be the killer number. But let's imagine you are an American moving over to the UK. Now, what you'll have to think about is that for residency purposes, and you don't have to be American, you could be just living in America, whereby the tax year starts from the 1st of January, I should say, to the 31st of December. So it's a calendar year, which is their tax year, which to me makes a lot more sense than the fiscal year. But anyway, ultimately, you've got residency days that's counted between those dates. Now, you could be someone who's British and saying, well, actually, I've been in America for a period of time. Will I be taxed in America? Well, unfortunately, you've got a different tax system there. But the problem here is that you could be a dual resident status, which means you could be taxed in both countries if you do not get it right. I said before, it could be the magical 183 days. Now, if you move from the United States, let's say in middle of July, well, you've been in the States for more than 183 days. You will have to do a 1040 tax return in that country. Now, if you, conversely, you move over to the UK around that July, well, don't forget the counting days starts from July all the way till April, which means you're resident in the UK as well. Hey, well done. You are going to be taxed by the IRS and by HMRC. Now, clearly, this doesn't relate just to an American, and it isn't just a way of me doing a shameless advertisement for Purser Tax, albeit that does really help. My point is that whichever country you're coming from where you are taxed, you will have a residency status, and when you move to the UK, you'll have a residency status as well. So make sure that you plan your trip with a tax advisor. Kind of doesn't feel comfortable, does it? But you do need to have all this back in your mind to prevent having a dual residency tax status and filing tax returns into different countries, especially where there's no double tax treaty between the UK and the country you're leaving. So really important for you to get some advice. Now, the big thing I'm going to talk about is domicile versus non-domicile. We'll look at resident versus non-resident in this video as well. And domicile, what does that really mean? Well, domicile for tax purposes, and there are many different variations of this. You can go to Wikipedia and I'll give you a very good explanation to what domicile means. But from a tax perspective, it basically means is you are going to be here, you're going to live out your days for the rest of your life, and therefore you are going to be taxed on your worldwide income. And indeed, you've got other taxes to consider, which we'll talk about that later on. But you are automatically now domiciled or deemed domiciled, even if you're not British. because you've lived in the country for 15 out of the 20-year period, which basically means that you are now going to get clobbered for tax purposes. And I often say to people that are clients of ours, isn't it time you buggered off? And I don't mean that in a horrible sense that I don't want your business anymore, but really, you could be subject to a huge inheritance tax bill in the UK because we've got such a minuscule IHT lifetime allowance. And therefore, you want to be leaving the country before it gets to that 15 out of 20 years so that your worldwide assets isn't pulled into that calculation. So cheerio, in the most fondest way that I could say it. Now, you could also be deemed a domiciled person in the UK if you are a UK passport holder, as in you are a citizen of the UK, you've lived here all your life, you haven't really travelled the world apart from holidays, but that doesn't count in this regard. You're going to be domiciled, okay, for tax purposes. And it could be the fact that you lived the rest of your days here, so you could have died here, and therefore your assets could be subject to inheritance tax. So you do need to be careful of where you are going to be deemed domiciled. Domicile basically means where you're going to be taxed. Everything is taxed worldwide, okay? Residency, slightly different connotation. But let's go through a bit more detail about domicile. Basically, what it's saying is any UK earnings you have as a domiciled person, as per the previous slide, you will be subject to income tax in the UK by HMRC. Not only that, if you are domiciled, your worldwide assets would be subject to income tax. So if you've got assets that generates you money like property, or you've got businesses, that's an asset, that too would be subject to income tax if you bring it into this country. In fact, even if you don't, you will be taxed anyway by the HMRC. You've got capital gains tax. Now, if you are domiciled and you've got property in Florida, for instance, not only will you pay taxes in America, but you'll also pay tax in the UK. So you have to be very, very careful with not just paying tax in one country, but you'll have tax in another country, as in the UK. And then you've got inheritance tax. And one thing, big differentiation I always say to people is, you'll hear me say a lot about American tax, and that's because I do so much work with this. But on inheritance tax in this country, it's only £325,000 per person, which is the lifetime allowance. So if you've got assets below £325,000 when you die, no income, no inheritance tax, not a jot. If you're a couple and you've got property at home, you could get away with having assets up to £1 million, which would be then free from inheritance tax. But if you're coming to this country and you've got assets all over the world, you might go over that £1 million, and therefore you'll be subject to 40% inheritance tax. And that's a huge clobbering when you're going to be deemed domiciled in the UK. And that's why I would say to people, just be very careful about being considered a domiciled person for UK tax purposes. And basically, I've just got to ask you the question, how much tax are you going to be paying as a result of being domiciled in the UK? And are there things that you can do to change it? Well, it would be a boring video if it wasn't, right? So the thing I would always say to you is, if you're either staying in the UK, moving to the UK, leaving the UK, whatever it is, especially if it's US tax and UK tax, I can really help you with those. But I would say to you now that you need to get tax advice before you leave or before you go to a country, just so that you don't get hit with those nasty tax surprises, which will come straight out of your pocket. And you can book a tax call with us using the code YouTube25, and you will get a 25% discount from that tax consultation. And don't forget, if you are a person that wants to invest in UK property in the UK, then why not talk about our services? I'm sure we can help you save lots and lots of that property tax. All right, let's talk about residency now. Now, I've talked about domicile. We're going over now to residence. Someone who is resident. What does that really mean? Well, so someone who is deemed resident is someone that is living in the UK for 183 days or has a home and living in it for 90 days. Now, there are a number of days, and I will put variations on home and get advice, because you can have a home for 90 days and only live in it for a period of time, and you're still deemed residents. So there are a few things. So this video is very much an introduction to UK residence tax status. But typically I would say if you're in the UK for more than 183 days, hey, forget it. You are going to be tax resident, and then you've got to be taxed on your UK income. And well, what about your worldwide income? Stay tuned. I will talk about that. Someone else who's resident will typically work in the UK for 75% of the time. So residency is where you live and where you work. And really, there isn't much more than that. So if you fit those criteria, you will be deemed to be resident. What if you don't meet that criteria? There are some other things that you need to consider, and that's where I would say get some advice before you make a decision of what you do. Now let's imagine you are considered to be UK resident. Well, what tax do you need to pay to HMRC? And you can feel a tear coming down my eyes here, because ultimately, if you are in the UK and you're resident and you come from America, Brazil, Hong Kong, China, and then you've come to the UK and you see that amount of tax that you pay compared to the countries you've been in, you will cry just like me. So you will have this income which you're going to be subject to UK tax on. And if you are going to be 15 years out of the last 20 years, you will be deemed domiciled. So your worldwide assets will also be subject to income tax as well. But if you've not been in the UK for 15 out of 20 years, you can use something called a remittance basis. I'll talk to you more about that in a second. Capital gains tax. If you're just resident in the country, you will be subject to capital gains tax on UK assets only. However, if you are deemed domiciled because you're living in the country for more than 15 years, guess what? Your worldwide assets is now subject to UK tax as well. That is a boohoo, and we need to stop that as much as possible. Inheritance tax, and again, this could happen by accident, let's be fair. You could face an inheritance tax bill on your UK assets. What you don't want is your worldwide assets being subject to inheritance tax. But it could happen, because if you are being and living in this country for 15 years or more, guess what? Your worldwide assets will be subject to inheritance tax. I'm hoping that I'm emphasizing this 15 plus years, because that is what's going to cause you the biggest headache and the bigger amount of tax that you have to pay across the world. So let's talk about someone who is resident but not domiciled. Now, domiciled, we've explained it already, so let's not go into that. Rewind the video if you need to. UK resident is someone who is going to be taxed on UK tax on worldwide income. Now, is that true? Well, actually, it could well be the case whereby you just accept, hey, tax me on everything and I'll just work out the difference. And what would happen is you would be taxed on your worldwide income, but you get this tax credit, your foreign tax. So if you've paid tax to the IRS or to another tax institution, you may, I say may, depends if you got a UK tax treaty with that country. Most times you will, to be fair. But you'll have a tax credit on the tax you've paid overseas, and then you've got potentially more tax to pay in the UK. And as a guide, rough guide, I would say that you've got a 30% tax in the US, as an example. China, or Hong Kong, I should say, more importantly, because I know about Hong Kong tax more than do China. But you've got a lot less tax there, maybe 6%, 8% even. When you come to the UK, all of a sudden you've got this 40% as higher rate taxpayer, 45% as additional rate taxpayer, huge amounts of taxes that you need to think about. And therefore, your potential UK tax, if you're going to be subject to worldwide tax, then unfortunately you will pay more to HMRC. Now, what I would say is no UK tax on high taxed countries. Now, pop quiz. Which country is taxed more than the UK? Don't know? There's not many. Europe, mainly. That's the only part. There's only some countries that are more taxed, like Italy, Germany. Potentially those countries will be high tax, and therefore you would not be subject to higher tax rates in the UK. But you do need to do your research to understand, well, how will this affect me if I've got assets that generate profits for me? Now, there is another opportunity. If you are a resident, you could say, hey, HMRC, I do not want you to tax me on my worldwide assets. Just tax me on my UK, thank you very much. And what I will do, every time I bring money into this country, then I'll allow you to tax me on that money I bring into the country. But don't you dare tax me on my worldwide assets. Can you do that? Yes, you can. So there is something called a remittance basis. And remittance basically means that what are you remitting into the UK will be subject to UK tax. Now, on that basis, what would happen is no UK tax on worldwide income. So you're free from that horrible tax called HMRC income tax. So you're free from that, but you are a HMRC remittance user and you will have tax charges. And this is a hefty charge, I have to say. If you've been in the country as a remittance-based user, and this has recently changed, interestingly enough, if you've been resident using remittance basis at 7 out of the last 9 tax years, you will be subject to £30,000. Gets worse. If you've been in the country for 12 out of 14 years, you're going to be taxed £60,000. And then you notice, no 15. What does that mean? Well, once you're 15, pop quiz. You should have known this. You become domiciled, and therefore it doesn't matter. You will be subject to worldwide tax on all of your assets. So this £60,000 is a huge charge, and you have to work out, well, should I just be taxed on my worldwide income because I get the tax credits from the country I'm in anyway? I bring that money in and the UK might tax me at 5, 10, 15,000. If that's the case, then just allow HMRC to tax you on your worldwide income. If you are earning millions out of the UK, then the remittance basis would be a good idea, and on the 14th year, you then leave the UK. That's my advice. All right, so I've told you how to pay minimum tax for UK, but there are so many other taxes that you're probably paying too much on. And that leads me to say, look, why don't you, if you're looking to invest in UK property, then book a consultation with us to talk about our services in general. If you are thinking about moving to the UK, leaving the UK, or indeed looking to about America, we can help you. So book a tax consultation about the whole domicile and residence basis. Use the code YouTube25 to get your 25% discount. Don't forget to smash that like button if you've enjoyed this video or at least got something out of it. Make sure you drop a comment. So if you are leaving the UK or coming to the UK, make sure you drop me your thoughts, your experiences of what you've had to date, and I'll drop my comments and feedback as well. Don't forget to subscribe to this channel so you do not miss the next video I launch. Until the next time, my name is indeed Simon Misiewicz from Optimise Accountants. I shall see you again soon.